income tax compliances while trading on the crypto exchanges from 1st July 2022? Don't worry, we are here to guide you on how TDS provisions will apply in case you transfer crypto. The Income Tax Act requires that you deduct TDS at 1% as per Section 194S while transferring the cryptos. Watch the video till the end to learn all about it. Hello and welcome, I'm Maheshri from Clear. We have assisted more than 80,000 tax experts and 6 million tax filers. To subscribe to support us and get a clear explanation of finance concepts. So, what does Section 194S say? As per Section 194S of the Income Tax Act, the person making a payment to a resident on the purchase of virtual digital assets, for example cryptocurrencies, NFTs, etc., shall be responsible for deducting TDS at the rate of 1% of the consideration paid on cryptos. The said provision is effective from 1st July 2022. Now the department has exempted certain persons from such TDS compliance. It is important to note that if the aggregate value of the consideration payable on crypto transactions with a resident is less than Rs 10,000 during a financial year, there is no requirement to deduct TDS. However, for certain specified persons, the threshold limit to deduct tax under Section 194S is Rs 50,000. The specified persons could be an individual or Hindu undivided family, that is HUF, with a business turnover not exceeding Rs 1 crore in a preceding year, or an individual or HUF with professional receipts that are not more than Rs 50 lakh in a preceding year, or an individual or HUF that does not have a business or professional income at all. Now let's look at who should deduct TDS. The plain reading of the provision is that the transferor must deduct and deposit the TDS amount before releasing the consideration. Thus, the guidelines state that in the case of a direct buyer-seller transaction, the buyer will be responsible for deducting TDS. When no broker is involved, the tax must be deducted only by the exchange when crediting or making payment to the seller. When the broker is the seller, then the responsibility to deduct tax will be on the exchange. When the broker is involved and the ownership is not transferred to the broker, the responsibility to deduct tax will be on both the exchange and the broker. However, the exchange can enter into an agreement with the broker so that the broker deducts the TDS. When crypto being transferred is owned by an exchange, the responsibility to deduct TDS has been shifted to the exchanges. It is because practically the buyer may doubt whether the VDA being transferred is owned by the exchange or not for tax deduction under Section 194S of the Act. So, exchanges have to enter into contractual agreements with the brokers or buyers wherein they can deduct the TDS that the buyer is supposed to deduct. They must maintain their entire transaction trail and disclose these transactions in their income tax returns. Please note that tax required to be deducted under Section 194S of the Act shall be after excluding GST or charges levied by the deductor for rendering service from the total consideration. Isn't it easier for you to know who is liable to deduct tax on crypto transactions? If it is clear, please comment yes in the comment section below. Now let's have a look at TDS provisions where one crypto is transferred for another. If you have transferred one crypto in exchange of another crypto or the payment is partly in kind and cash, then there will be a practical difficulty in complying with the TDS provision. Hence, an alternate option is provided where the exchange can deduct tax based on the written contractual agreement with the buyers or sellers. The government has provided a mechanism for the exchanges so as to exercise such an option. As seen above, the burden of compliance of TDS deduction is mostly on the exchanges. The tax deducted is required to be reported to the government in Form 26Q. Moreover, if there is a written agreement between the exchange and the broker or seller for shifting the responsibility of tax deduction, the exchanges are required to furnish a quarterly statement in Form 26QF before the specified due date mentioning all the details of such transactions and report the same while filing the ITR. The investors are required to deduct tax in case of peer-to-peer transactions. In cases where the consideration is in kind or there is a swap of VDAs, the tax deducted must be deposited to the government before releasing the consideration. The specified persons deducting tax under Section 194S are required to issue a TDS certificate in Form 16E to the person on whose behalf TDS is deducted. The certificate must be issued within 15 days of furnishing the challan cum statement in Form 26QE. Once the seller initiates a sell transaction, the net consideration, that is total consideration after reducing commission, discount, GST, etc., will be credited to the seller's wallet. When you withdraw the same into your registered bank account, there are no additional taxes. The seller's Form 26AS will show all the TDS deduction details in every quarter. They can adjust the deductions against their total tax liability while filing ITR. I hope this video was helpful for you. For tax filing or finance related queries, you can contact our experts by clicking on the chat link provided in the description box below. Also, don't forget to subscribe to our channel for more such informative videos and stay tuned for more updates.